Welcome to The Investing Show, the show where we talk about the news that matters to investors and get some ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio today, we've got Richard Hunter, Head of Equities at Hargreaves Lansdown.
Simon.
Richard. And Nick Batsford, CEO of Tip TV.
Simon.
Nick. Coming up later on today's show, we've got Hugh Yarrow, manager of Even Load Income Fund, who's got his 10 dividend shares for the next 5 years. First, though, a look at some things that have been in the news. Richard, house builders. For investors who've bought into house builders, they have been the gift that's kept on giving over the past year, haven't they? So what's happening here?
Yeah, they absolutely have. I mean, casting our minds back, seems a distant memory now, but casting our minds back a couple of months, there was a great deal of concern around the house builders on the basis of we didn't know who was going to win the election. And depending on who got in, of course, there was the possibility of mansion tax and the like, which put the skids under the sector. Obviously, that was then blown away. It looks like we haven't got to worry about mansion tax now for another 5 years. And in the background, yes, during the financial crisis, many of the better run house builders had been picking up cheap land at a time when no one else wanted to. Clearly, we've got this accommodative interest rate environment as well. We've got virtually nil inflation. So you've got a situation where we've got rising house prices and that cheap land I mentioned, which is a builder's dream. As such, and they've been able to generate great deals of cash. Persimmon, for example, are actually in a net cash position at the moment. That's quite apart from any help they might have been given by the likes of the government Help to Buy schemes. So it really is pretty much a perfect storm, but in a positive way for the house building sector at the moment. And that's quite apart from the fact, of course, that in terms of the unemployment situation also improving in the UK at the moment, job creation is also going to support incomes, which in turn, of course, is going to mean that mortgages are more available. So with all of those tailwinds in place, what could possibly go wrong?
Well, they're the classic cyclical share, aren't they, house builders? But, I mean, the balance sheets, as you say, look a lot better this time. So what could go wrong?
Well, interest rates will rise at some point. That may or may not lead to some crimping of mortgage availability. But I think the main concern in terms of the sector at the moment is if you have a look at how the shares have been performing of late. And we've got a table of just a selection of house builders. The top three are in the FTSE 100. As you can probably guess from the market capitalisation, Bovis in the FTSE 250. It's the share price column which I really wanted to concentrate on. This is just over the last year, and as you can see there's some pretty substantial returns being generated, and this in turn has started to raise some valuation concerns, in as much as there's been this absolutely perfect environment for house builders. How much further can they go? Persimmon very recently had its half-year results out. They were extremely strong. Revenues were up 12%. Pre-tax profit was up 31%, but the shares were down over 2% on the day. And as you can see, the market consensus has recently gone south to a weak hold. And again, that's totally on valuation concerns. How much upside is there? Perhaps one of the, perhaps by way of explaining the way the market's thinking, if you look at Bovis there, it's returned a mere 35% over the last years, and probably on a valuation basis, it's probably the most strongly favoured in terms of consensus.
It's got more ground to make up, hasn't it?
Absolutely. Putting all that aside, and the quite incredible share price performances that we're seeing there, obviously, and as we'll be discussing later, dividend yield is normally something where a lot of cash-generative companies simply are choosing to use that cash on other things. But as you can see here, I've done the projected dividend yield because there's a slight complication with Persimmon in that they're doing a capital return plan, so the current yield in most places that you look actually says nil, although that's not the case. So I've done a projected yield, but as you can see, with interest rates where they are and likely to remain similar for the foreseeable future, and the FTSE 100 yielding probably 3.5 on average, there's an element of even if those share prices don't continue at that accelerated rate, you're getting a pretty good income stock to boot.
Yeah, well, interestingly enough, that projected dividend yield on most of those shares is higher than the rate you'd be paying on a mortgage right now, isn't it?
Yeah.
Absolutely, absolutely right. Yeah, and of course, if there is or were to be any sort of weakness in any of those share prices, the yield would go higher on the basis of the relationship between dividend yields and share price.
I've got to be said, Richard, okay, I'd be a cautious buyer of anything that's up 80% year on year.
Yeah, well, do you know what? I've declared my hand here. I've got some shares in Barrett's.
Well done, you.
Actually. So, yeah,
how long have you had
they've done
them?
fantastic. Yeah. Well, I've had them over a year, actually.
Well done.
And they've done very well, because I thought that there was this strong, political tailwind, basically. Every single political party says we need to build more houses. So that there is this momentum behind them. But I have looked at them, and I have looked at my portfolio, of which they are a small part, but I've looked at it and gone, should I be selling some of these? Should I be locking in some of these gains? But then, as any investor knows, there's always the concern that actually there's further to go and you're going to jump out too soon.
Well, there is that. Of course, you can always do what they call top slicing and maybe take some of your holding away, maybe even take enough of your holding away so that what you're left with is pure profit. In other words, you've paid yourself back for the initial purchase. But what you're doing here, logical though it sounds that there may be limited upside from here on in, given that share price performance, the purple patch that the house builders have is going to remain for some time, and what you're now calling, if you were looking to get into this sector, is how much longer you think that's going to last. Now, quite apart from mortgage availability that we mentioned, I think it's generally accepted that any interest rate rises take between 1 and 2 years to actually filter through to the economy. So whilst, because it's a cyclical sector, it will find difficulty at some point, you may still have an opportunity to continue to ride that way for a little while yet.
There's something else putting a bit more money in people's pockets as well that's helping this along, isn't there, Moose? It's
let's talk newspapers.
Let's talk the oil price.
Well, there was a couple of sort of headlines that caught my attention over the weekend. Petrol prices falls could drive return to deflation. Now, in terms of deflation, I'm very worried that central banks are still talking inflation, not deflation. And basically, falling oil prices are one of the major concerns for the global economy. Anthony Hilton in the Evening Standard last night, beware the swings and roundabouts of falling oil prices. Now, if you just think back, OK, markets tend to forget where we come from. 10 years ago, we talked of peak oil. They were talking about new big oil supplies being unlikely. Demand would continue to rise. There was a talk of the commodity super cycle driven by China. All the world's basic materials, iron ore, copper, wheat and the likes, OK, everything was just going to go up. It was a one-way bet. Basically, the brokers told their clients, just buy. They're going up to the moon. Goldman Sachs, March 2008, said crude oil is going to $200 a barrel. The global economic crash never got above $150, and I just want to put it on file. I did say on CNBC at the time, that's the top of the market, and that video is out there. Obviously, in the last year, China's come off the boil, one-way traffic, OK. Now, where's it going to go? We're down 20% year to date. Investors' Intelligence have got a model. They're suggesting crude can go down to $25. Which again is considerably further down from where we are now. OPEC production's now at a 3-year high. We've got Iran entering the scene, okay, in terms of the easing of the sanctions, talking about opening the floodgates there. The US fracking industry has shown greater resilience in terms of price pressures. Now, Goldman's are now saying it could be $50 for the next 5 years, and I'm not sure if I believe that on the back that they were calling it up to 200. Does it matter with crude being so weak? Well, the FTSE oil and gas accounts for 15% weighting of the FTSE 100 index, so it's clearly a laggard in terms of the market. Global politics, we've obviously got Nigeria and Venezuela, that's well documented. We've got the weakness in the oil price affecting Russian politics. It suggested that Russia is more aggressive in its foreign policy while the oil price is plunging. Scottish independence, we saw that going into the general election, the play on oil. And then finally, we've got renewable energy, OK? If we're going to finally get serious about renewable energy, is that going to push crude or further down? I'm a seller for choice.
I think if the oil price sticks at this low level and sticks there for a year and a half, 2 years, that's going to make a real big difference, isn't it? Because there was an expectation, sudden plummet down, might level off and then bounce back up, which it did, but then it sunk back down again, hasn't it?
Yeah, a couple of the oil majors, Shell and BP spring to mind, recently had half-year numbers, and they were suggesting that in terms of their longer-term business strategies, I think they're looking for somewhere sort of 60, 70-ish for certain projects to remain viable, quite simply, because usually when you're extracting oil from the ground, you need oil to get the oil out. And certain, because obviously it's a finite resource, it's therefore becoming more difficult to find, more difficult to extract, so it's more expensive, and the viability of some of these projects has been brought into question by what could be a lower for longer oil price.
Well, coming up soon, we've got Hugh Yarrow of the Even Load Income Fund to talk about dividend shares. But first, the money tip of the fortnight. Now, it's summertime, everything's a bit quieter, it gives you a bit more time on your hands, so this is a good time to take a look at your portfolio, but also not just at what you invest in, but how you invest. That matters too. Take a look at the platform that you're investing in. Is it right for you? Are the charges right for you? Because different platforms have different functions that help people out. They also have different charges that might make one better for you and better for someone else. You can see a roundup of them on our site on thisismoney.co.uk/platforms, which runs through the ones that we like and can help you choose whether you're in the right place. Join us after the break. Welcome back to the Investing Show. Joining us here now, we've got Hugh Yarrow, manager of the Even Load Income Fund. Hugh, welcome to the show.
Hi, Simon.
Thanks very much for coming in. Now, the Even Load Income Fund, tell us a little bit about how it works, how you invest. I understand you invest in a relatively small number of stocks compared to some managers, do you?
Yeah, we are structurally biased towards certain sectors, and our focus is really free cash flow. So we like businesses that don't need to channel much capital into their business to grow. So sectors like consumer branded goods, media, software, healthcare, specialty engineering franchises. Businesses that have intangible assets like brands, intellectual property, are the sorts of sectors that we are attracted to. And we like businesses where, at the end of the year, you have a lot of cash left over to pay dividends, and you don't need to reinvest much of that cash back into the business. And over time, therefore, the dividends can grow at a nice rate.
So with that in mind, you've done a report, Dividend 2020, 10 dividend growth stocks for the next 5 years. Now, I can read down the name of the companies here. We've got Reckitt Benckiser, Burberry, Sage, Spectris, PZ Cousins, Euromoney, WS Atkins, Rotork, Diploma and Paypoint. That's quite a diverse list of companies. Tell us what you like about those companies. What was it you did when you were looking for this list and these names?
Yeah, I'll just caveat this whole study with the point that this was an illustration that we did. Dividend sustainability in the UK market is very topical at the moment, and we just wanted to show some of the factors we look at. We actually currently own 7 of those stocks on the list. One of them is Reckitt's that we've been reducing on valuation. There's not much of a valuation discipline there. We've just got a 2% yield cut-off. But the key point we wanted to make was this point on free cash flow covering the dividend. Now, if you think of some of the high-profile cuts in the UK market over the last year or so, the supermarkets, so Tesco, Morrison's, businesses like Centrica, these are quite capital-intensive businesses which have to invest a lot of their money back in the business to grow, and they haven't been generating free cash flow. And if you're doing that, and you could argue that the oil majors are in this situation at the moment, you're actually funding your dividend from increasing your debt level, or you could raise equity to pay your dividend, and clearly that's only sustainable for a limited amount of time, or you end up with a balance sheet problem. So what we're looking for here is companies that not only have strong balance sheets, but who at the end of the year get left over with this nice amount of free cash flow that comfortably covers that dividend yield. So it's, if you like, a safety buffer. So even if they go through difficult times, then they've still got some spare cash to pay and grow the dividend.
And for anyone watching who would question, well, I don't know what free cash flow is.
Yes.
What is it in the simplest terms?
It's a very good question. So if you think about the sales each year that a business generates, the cash, you pay your expenses, you pay your interest, you pay your tax, and then crucially, you then need to reinvest some of the cash earnings that you get left back in your business, literally in factories, in barrels of oil if you're an oil major, in capital expenditure and working capital. And free cash flow is after all of those expenses, including the working capital and capital expenditure from the business. And that is, it's really what's left over in the till at the end of the year.
And when you're looking at companies, that's obviously a very important factor. But the thing that you've picked up on here, I think, with this list is not just absolute dividend yield, going out and looking for the highest dividend. It's this opportunity of growing dividends, isn't it?
Yes, and I think that's if you get pushed too far up the dividend yield and go for really, really high yielders, then there tends to be a higher risk of dividends not being sustainable. And I think there's a sort of nice sweet spot in the middle where you've got a nice initial starting yield, but where there's good potential for growth over time. And, you know, if you can buy a company on a 3% yield and it can grow at 5 or 6% per annum for 10 years, then you've probably got a high single-digit, double-digit total return. So that is it's an income and growth approach, if you like. And if you push too far up, then you're likely to find that free cash flow isn't covering the dividend by very much or at all.
And also, of course, a high dividend yield on its own could just be a factor of a weak share price, given their inverse relationship. In terms of dividend cover, there used to be I think it used to be generally accepted that you were looking probably for a figure of sort of 1.5.
Yeah, I mean, I think we like a cover of 50% over the dividend, certainly, and I think the stocks in those lists are all there or thereabouts or comfortably higher than that. But clearly that gives you a good safety buffer if you have a tough year. All businesses are cyclical in some way and will go through more difficult times. What you want is that safety buffer so that when you do have the tough year, you've still got more free cash flow at the end of the year than the dividend payment.
And how often do you actually run the model to find these securities? And are they very easy or difficult to find?
You do need to be selective, and you do tend to find them in certain sectors, as I say, that have the right sort of microeconomics in terms of not needing to channel lots of more money back in. We screen the market, but we also do detailed models on individual companies that go back for 10 years or more.
Right.
And we have an investable universe of about 85 companies, which are companies where, from a quality perspective, we think they fit the bill. But they may not at this current point be attractively valued enough to include in the fund.
Okay.
And I think that's a really important point to make about a list like this, isn't it? And you touched on this earlier. To an investor presented with a list of 10 shares like this, where someone's done a screen and they've picked out 10 opportunities, what's the next step? What do they do next? They don't just pile straight into all 10, do they?
No, and I'm an old-fashioned stock analyst, and I think it's important to really understand the qualitative aspects of a company and its franchise. I think it's worth doing the fundamental research on understanding the market position of the company, the long-term prospects of the company, who its competitors are, and really getting to know a business. I think just to invest purely on a quantitative screen could be quite a dangerous game.
Yeah. So of this list here, tell us a little bit about some of the shares and why you like those companies.
Well, Sage is one of our major positions. It's a software company that provides enterprise software to small and medium-sized businesses globally in more than 100 countries all over the world. It was great. The British business started in Newcastle in the early 1980s, and it's sort of grown gradually over time. 70% of its revenues come from subscriptions, and they have very high renewal rates, so there's a nice sort of repeatability to the cash flows, and they are growing their revenues at a very nice rate, and they've just increased the dividend by 8%. But if you look back long term, their record of annual growth has been in the high single digits, double digits, depending how far you go back. So it's a real cash machine, if you like. It generates, if you think about it, it doesn't have much in the way of physical assets. It's a software company. And the users get very used to using those products and don't want to change.
Once they're using it, they're really worried about moving away from it to a competitor.
Yeah, if you're an accountant in a small business and you get to know a Sage package, you're unlikely to want to move to another one because you just get familiar with it and it becomes embedded in your day-to-day workflow. Yeah.
What about Burberry? That's on the list as well. That's a company that's had a bit of a turmoil.
Yeah,
recently,
well, that's not one we currently own, actually, but it does have the characteristics we like. It's in our investable universe. Clearly, at the moment, there is a concern that a lot of its sales are either to China or to Chinese consumers travelling around the world. And the sales growth has weakened, but we think longer term, the brand is very strong. It's got a very strong international reputation. The business is very cash generative. The balance sheet is extremely strong, and the dividend is very well covered by free cash flow. So taking a slightly longer term view, and 5 years is a long term investment, the potential for good dividend growth is there, and despite the sort of current downturn, the dividend growth is still continuing at an attractive rate.
And there's another share on here that caught my eye as well. There's some of the ones where the names are much less well known than a Burberry or a Reckitt Benckiser. Diploma, what do they do? What's that company?
Yeah, well, you wouldn't have heard of it. It's a specialist niche distribution business. It has a variety of different businesses selling into mainly US and European markets, but they do things like seals for heavy equipment in the US and healthcare products and electronic bits and pieces. But the key is that they have very strong market positions in the niches that they dominate, and they've got a very, very good management team that's got a very good record of investing capital at a good rate of return over time. Again, you've actually picked out another one that we don't currently own. We did own it in the fund and we sold it on valuation. It's got exposure to the US economy, which is partly why it's performed very well recently, because people are clearly more positive on the US at the moment. But yes, it's a slightly dull and boring business, but it's been very kind to shareholders over the years.
Richard, obviously investors, this far into, ultra low interest rates and a bull market, they're hunting for income everywhere, aren't they? Do you think going off the beaten track a bit for income shares is something that people are doing more at the moment? Well,
they are, but hopefully subject to the parameters that Hugh's mentioned, obviously, rather than just looking at the yield on its own, which can be misleading. But I think the other point of view, the point to mention for any private investor, whenever you're talking about dividends, is the wonders of compound interest. And if you are in a position where you're able to reinvest the dividend into that holding, assuming you still like the holding that you have, as we've said many times, Einstein called it the eighth wonder of the world, and it's something which really can improve your performance over a period of time.
It does pay off over time. It really has the power to boost returns. Hugh, of the shares that you do hold at the moment in the fund, is there any that stand out that you think as your favourites, that you think have the best prospects at the moment?
Well, in terms of the position size, Sage is our largest position, and I do think that's it has traded on a higher yield in the time that we've owned it in the fund, but we still think the potential for growth and the cash generative potential from that company justifies the current valuation.
Okay, brilliant. Well, that's all we've got time for today. Thanks very much for coming in to see us. Hugh, thank you. Richard, thank you. Nick, thank you.
Yes, sure.
Join us next time on The Investing Show. See you then.